Have you ever wondered if there's a secret club of investors who consistently beat the stock market? Or maybe you've looked at your own investments, or lack thereof, and felt like it's all just a complex game of chance? What if I told you that for most people, trying to win at investing is actually the biggest mistake, and the path to real wealth is surprisingly boring? Forget chasing the next hot stock tip. Today we're diving into some hard data that might just flip your entire investment strategy on its head. Welcome to the channel. Today we're tackling one of the longest running debates in the investing world: index funds versus active investing. This video isn't for the day traders or the high frequency algorithms. This is for you, the everyday person, whether you're just starting out or you've been investing for years, who wants to build financial security without turning it into a second job. Understanding this difference isn't just about picking an investment. It's about understanding how your money can truly work for you, efficiently and powerfully in today's economic climate. Let's start with what most people imagine investing to be: active investing. Think of a super smart fund manager working in a skyscraper, constantly researching companies, buying stocks they believe will outperform the market, and selling those they think will lag. Their goal is simple: pick the winners and avoid the losers, making more money than the overall market. It's like being a scout for a professional sports team, always looking for the star players, analyzing every stat, and making trades hoping to build the best possible roster. This requires a lot of time, a lot of skill, and usually a lot of fees for the person doing all that work. Now, let's talk about the challenger, the index fund. Instead of trying to pick individual winners, an index fund does something radically different. It simply buys a tiny slice of every company within a specific market index. The most famous example is an S&P 500 index fund, which holds pieces of the 500 largest US companies. So instead of being a scout trying to find the next superstar player, an index fund is like buying a tiny ownership stake in the entire league. You're not betting on one team, you're betting that professional sports as a whole will continue to grow and be profitable. Simple, right? This is where most people mess this up or get sold a dream that simply doesn't exist. You'd think those highly paid, brilliant active managers would consistently beat the market, right? The data tells a different story. Year after year, study after study, the overwhelming majority of active fund managers, we're talking over 90% of them, failed to outperform the simple S&P 500 index over a 15-year period. Think about that for a second. Even with all their resources, research, and expertise, most professionals can't beat just buying a little bit of everything. If you remember only one thing from this video, it's this staggering statistic. So, why do index funds consistently win? Two major reasons: fees and diversification. Active funds often charge 1% or even more in annual fees. That might sound small, but over decades, it quietly eats away at your returns, compounding against you. An S&P 500 index fund, on the other hand, might charge just 0.03%. That tiny difference becomes hundreds of thousands of dollars over a lifetime. Plus, index funds offer instant, broad diversification. You're not relying on the success of just a few companies, but on the entire economic engine of hundreds of companies. It's a far less stressful way to invest, and statistically, far more effective. Even the legendary investor Warren Buffett, perhaps the greatest active investor of all time, advises most people to invest in low-cost S&P 500 index funds. He famously won a $1 million bet against a hedge fund manager who claimed he could outperform the S&P 500 over 10 years. Buffett put his money on an index fund and his prediction proved correct. If one of the smartest stock pickers in history says this is the best path for you, it's probably worth listening. He understands that while he can pick winners, it's an incredibly rare skill, not a common one. Let's clear up a few common misconceptions. Myth number 1, index funds are boring. Well, yes they are, but boring often means consistent, and consistent means growing your wealth steadily without the emotional roller coaster. Myth number 2, my financial advisor can pick the winners for me. While a good advisor is invaluable for planning, their ability to consistently pick outperforming funds or stocks is, again, statistically unlikely. And finally, some think active funds are safer because experts are watching them. In reality, the high fees and poor performance of many active funds often make them riskier to your long-term wealth than a diversified, low-cost index fund. So what should you do with this data? First, consider making low-cost, diversified index funds a core part of your long-term investment strategy. Second, don't confuse excitement with effectiveness. Slow and steady really does win the race here. Third, be mindful of fees. Even tiny percentages compound into significant amounts over time. Fourth, focus on what you can control, your savings rate, your investment strategy, and your emotional discipline, rather than trying to beat the market. The data is clear. For most investors, simplicity and broad market exposure, delivered through low-cost index funds, are the most effective path to building long-term wealth. Now that you understand how to invest efficiently, the real question is how to make sure you have enough to invest. In our next video, we'll dive into the hidden costs that quietly destroy most people's ability to save, and how to identify them before they drain your bank account.